And I set these up more than 10 years ago. And I didn't have to do them on Blackboard. There's a little app called Respondus. You can actually create algorithmic questions very easily. Creating an algorithmic question on Blackboard is worse than getting a root canal without any anesthetics or anything like that. I think we're getting out of Blackboard at school, if I'm not mistaken. Doesn't matter to me. I just use Blackboard as a place to put stuff in. I don't use any functionalities of those. And your homework assignment is also there now, but it's not going to be live until 12:30 on Monday. On these, I have typically 2 Excel files. One of them is always a solve problems. Those are problems that are similar to the one in homework. We basically solve them in Excel. And there's also this YouTube playlist. It actually records the video of me doing those solved problems. Each are, depending upon the problem, anywhere from 2 to 8 minutes. I strongly recommend that you watch them. Whether or not you do, it's your business. Maybe next year I'll do something about it. On those videos, I can actually insert quizzes. If you watch the video, you'll be able to answer simple questions about the video. And let's see how much it helps watching the videos. Since I'm going to teach 3 sections of the same class next year, I can always have the control group and the treatment group. Whenever you get a chance to research something, it's always a good idea. Okay, now let's start talking about, we already covered kind of the nature of financial statements, especially balance sheet and income statement. Now let's talk about a little bit of identities, accounting identities, because we're going to keep using these things. So the mother of all accounting identities is the so-called balance sheet identity. And that's going to be total assets are equal to total liabilities plus total equity. You may have noticed that I have 3 bars over there instead of 2 bars. In mathematical notation, that means that is an identity or it's a definition. Since we're not defining assets that way, that's an identity. An identity means an equation that always has to be true. If it is not, you've done something wrong. An equality means they're equal, but sometimes they may not be. That's why we talk about solving equations. We never talk about solving identities. Because identities always have to be true. And when I say TA, I always mean total assets. And the E will always be equity. L will always be liability. And T will always stand for total, unless I say otherwise. That's basically my abbreviation system. You guys should be used to that. And I learned a lot of them from my sons, especially my younger one. I ask him a question. He says, Ihni. I said, what the hell is Ihni? I have no idea. So why didn't you say so? Apparently, time is too precious to write. I have no idea. You can even, the way I do it, I teach abbreviations to my texter. If I say on W, it actually expenses it on my name. I believe in communicating properly in any language. Now, you can also write total assets as current assets plus net fixed assets. Here C is current, F is short for fixed, and N is short for net. And we can write total liabilities as current liabilities plus long-term debt. AKA non-current liabilities. In fact, let me put 3. We can also define a useful quantity. It's called net working capital. Simple current assets minus current liabilities. This meant a lot more in the old days, where banks didn't have products like a credit line or lines of credit. A line of credit is a facility a bank provides you. If you need it, you can go ahead and withdraw money from that. As opposed to a loan, you borrow it and you charge interest. On a line of credit, unless you actually borrow it, they're not charging interest. Of course, they sometimes charge you a fee to keep that line of credit. It depends upon your agreement with the bank. But before all of that, this means, remember, current assets are, roughly speaking, value of assets that you could conceivably convert to cash quickly over the next year or so. Current liabilities are liabilities that are due over the next year. So the difference between the two tells me kind of how much short-term solvency I have. If I'm a short-term creditor to this firm, I want to know about that. Do these guys have enough stuff, if need be, to convert into cash to cover what they owe me? Which means we can expand the entire balance sheet identity as total assets are current assets plus net fixed assets, and they're equal to current liability plus long-term debt plus total equity. A clever rearrangement of this shows net working capital plus net fixed assets. I simply took the current liabilities to the left of the equation. So any one of these would help you out in solving a problem. There's one more thing in total equity. Total equity is kind of decomposed into 3 pieces. One is called I think just capital plus paid in surplus plus accumulated retained earnings. These two, capital and paid in surplus, is basically the capital investment of the firm. What capital is, each firm issues a certain number of shares. Let's say they have 1 billion shares. And companies assign a certain nominal value to them. Typically, it's about 1 cent. If you have 1 billion shares, then at 1 cent, they're equal to, what, $10 million? Yeah, okay? But when they issue these shares and sell it to their shareholders, they get sometimes more than 1 cent. You know, Google went IPO. They didn't sell those things at 1 cent. At the time, before the split cent stuff, they sold it at $50 a share, IPO. The difference between that nominal value of the capital versus what you got is called the paid in surplus. So when we look at the raised equity, you can think of that as raised equity. It's capital plus paid in surplus. The rest is accumulated retained earnings. Every time firm makes money, their net income is positive. They can do two things with it. They could either pay dividends, or if there is anything left, they can add that to retained earnings. By the way, there is no rule or law that says you cannot pay more dividends than your net income. In that case, you add a negative number to your accumulated retained earnings. Remember, dividends are, company says, I don't need this money, how about I give this to my own shareholders? It's like getting money from your left pocket to your right pocket. Is there a cop that says somebody puts more money to your right pocket, that's your net income, but I already had some money in there. So in addition to what somebody put in there, I could take some more out, put it into my left pocket. It's my money. How I distribute it between pockets doesn't matter. When you have certain securities, which we're going to cover in Chapter 7, there are kind of limits to what you can pay as regular dividends. If you have preferred stock, for example, and if you sometimes